Hi, I'm Ali, and in this lesson we will discuss audit strategy. ACCA 300 requires that an auditor establish an overall audit strategy. So, what is an audit strategy? Audit strategy is the finalization of the amount of time which the auditor will be spending on testing the client's internal controls and conducting detailed testing of transactions and account balances. An audit strategy depends upon the preliminary inherent and control risk assessment. It sets the scope, timing, and direction of the audit and provides the basis for developing a detailed audit plan. So now this figure provides example of audit strategies for two extreme cases, such as a high-risk client and a low-risk client. In case of a high-risk client, when inherent and control risk are assessed as high, means the risk of material misstatement is assessed as high, then an auditor will set detection risk as low to reduce audit risk to an acceptable low level. By assessing control risk as high, the auditor has determined that their client's system of internal control is non-existent, or not effective, or very poor, or unlikely to be effective in mitigating the inherent risks identified. When the risk of material misstatement is high, the audit strategy set by the auditor is to do no or very limited tests of control and place increased reliance on substantive tests of transactions and account balances. For example, a client sells expensive medical testing equipment and has has limited security. So if even a few pieces of equipment go missing or are stolen, it will have a material impact on the value of inventories. So in this case, inherent risk is high for the existence of inventory. Stock may be recorded that does not exist. Control risk is high as there are not control in place to mitigate the identified risk. By assessing control risk as high, the auditor will adopt a predominantly substantive approach. When auditor adopts this approach, the auditor will gain the minimum necessary knowledge of client's system of internal controls as required by the auditing standards, but generally conducts no tests of controls. If a client's system of internal controls is non-existent or unlikely to be effective in mitigating an identified inherent risk, there is generally no point testing the internal controls as the auditor will not be planning to rely on them. Instead, the auditor will increase their level of reliance on detailed substantive procedures, which involves extensive testing of year-end account balances and transactions from throughout the year. So the next scenario is where control risk is low. In this case, auditor will obtain a detailed understanding of their client's system of internal controls as they plan to rely on that system to identify, prevent, and detect material misstatements. Once an auditor has gained a detailed understanding of their client's system of internal controls, their audit strategy will be to conduct extensive tests of those controls. So if tests of controls are conducted and found to be effective, the audit strategy will be to reduce reliance on detailed substantive testing of transactions and account balances. Note that an auditor can never completely rely on a client's system of internal controls and will conduct some substantive procedures to gather independent evidence regarding the numbers that appear in their client's financial report. I just discussed an example in the previous slide for the development of an audit strategy at the financial report level. In practice, an audit strategy is developed for each identified risk at the assertion level. Risks are identified during gaining an understanding of the client. As we looked at this in earlier videos, the factors that impact the identification of risks ahead of Developing an audited strategy includes consideration of the economic and regulatory environment in which the client operates, the client's business processes and activities. This figure provides details of the process used by an auditor to development of an audited strategy for identified risks. So, at the transaction level, firstly, the auditor will first gain an understanding of the flow of transactions for the client. This means that each transaction flow is traced from inception to recording in the general ledger. So, when conducting this transaction walkthrough, the auditor will identify risk factors. For each identified risk, the first step is to assess whether an internal control could reduce the likelihood of a material misstatement occurring as a result of the risk. If the auditor believes one or more controls could be designed to mitigate the identified risk, they will assess whether the client has controls in place. That is, do they exist? If the client has one or more appropriate controls in place, the audited strategy is to test the effectiveness of those controls. That is, do they work? If after testing those controls, the auditor concludes that they are not effective, or if they are effective, the auditor plans to rely on those controls and is able to reduce their reliance on detailed substantive procedures. However, if the auditor tests the controls and believes them to be ineffective, which means controls do not work, the auditor cannot rely on those controls. In that case, the auditor reports the weaknesses identified to those charged with governance, makes recommendations on improving the controls, and increases the reliance placed on detailed substantive procedures. If the client does not have in place appropriate controls for the identified risks, the audited strategy is to conduct few or no tests of controls for the identified risk. The auditor reports to the weaknesses identified to those charged with governance, makes recommendations on improving the controls, and increases the reliance placed on detailed substantive procedures. So that's the end of this lesson, and in the next video we'll talk about what is materiality.